Hello everyone. Today we are diving into the world of SIPs, systematic investment plans. Whether you are new to investing or looking to understand how SIPs can benefit your portfolio, this video is for you. So what exactly is an SIP? SIP stands for Systematic Investment Plan. It's a method of investing in mutual funds that allows you to invest a fixed amount regularly, be it weekly, monthly or quarterly, into your chosen mutual fund scheme. Think of it like a saving habit, but instead of saving money in your piggy bank, you're investing it in mutual funds. Now let's break down how SIPs work. When you set up an SIP, you're buying mutual fund units with each investment. The amount you invest helps you buy more units when prices are low and fewer units when prices are high. This is called rupee cost averaging, and over time, it can help reduce the average cost of your investment. One of the biggest advantages of SIPs is that they encourage disciplined investing. You don't need a large sum to start. You can begin with as little as a few hundred rupees each month. SIPs are flexible. You can start, stop, or modify your investment amount at any time. Secondly, it's convenient. Set up auto debits from your bank account and your investments take care of themselves. And most importantly, it harnesses the power of compounding. Your investments earn returns and those returns earn more returns. Over time, this can lead to significant growth in your investment. In summary, SIPs are a smart way to invest in mutual funds, especially for those looking to build wealth over the long term without the stress of timing the market. It's also about regular investments to work towards your financial goals, whether that's buying a home, funding education, or planning for retirement. Remember, investing is a step towards securing your financial future, and SIPs could be a great start.